Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and with me is Mike, our industry expert. Today, we're diving into United Airlines' 10K filing for fiscal year 2025, filed February 12th, 2026. Mike, this is our first deep dive into United's annual filing, so we're establishing a baseline narrative here.
That's right, Sarah. And what's striking about this filing is the financial strength it reveals. With $19.81 billion in revenue, $4.71 billion in operating income, and $3.35 billion in net income, United is demonstrating robust profitability in what appears to be a normalized operating environment.
Let's get to our narrative classification. Since this is our first United filing, how would you characterize the story this 10K tells?
The narrative has hardened because United's debt structure shows $11.49 billion in total debt against $5.94 billion in cash, creating a significant leverage exposure. And because their operating margin of nearly 24% suggests they're operating at peak efficiency levels that may be difficult to sustain. This creates a story of strong current performance, but with structural financial constraints that could limit flexibility.
That's a fascinating tension between operational excellence and financial structure. Let's dig into the material changes and pressure points. What's the dominant financial story here?
The single most important financial reality is United's margin structure, operating at what appears to be peak levels. With operating income of $4.71 billion on $19.81 billion in revenue, they're achieving a 23.8% operating margin, which is exceptionally high for the airline industry. This creates three critical pressure points.
Walk me through those pressure points.
First is margin sensitivity. Operationally, when you're operating at these efficiency levels, any cost inflation or revenue pressure directly compresses margins because there's limited room for further optimization. For investors, this means earnings are highly sensitive to economic cycles or operational disruptions.
And the second pressure point?
Liquidity flexibility. With $11.49 billion in total debt against $5.94 billion in cash, United has a debt-to-cash ratio of nearly 2.1. Operationally, this debt load requires consistent cash generation to service, limiting their ability to weather extended downturns. For investors, this leverage amplifies both returns in good times and risks in challenging periods.
What's the third pressure point?
Cost structure durability. The gap between their $19.81 billion revenue and $4.71 billion operating income implies $15.1 billion in operating expenses. Operationally, maintaining this cost discipline requires ongoing management focus and favorable external conditions. For investors, any cost inflation in fuel, labor, or maintenance could quickly erode these exceptional margins.
Let's move to management commentary. What signals are you picking up from their tone and strategic messaging?
Here's where we hit a significant limitation in this filing. The extracted MD&A summary shows no key management quotes, which is unusual for a major airline's annual report. This absence of management commentary is itself a signal.
How do you interpret that absence?
The lack of extracted management commentary suggests either highly standardized, non-committal language or a focus on operational metrics rather than strategic vision. Operationally, this could indicate management is focused on execution rather than transformation. For investors, the absence of clear strategic messaging means you're investing based on financial performance rather than management's forward-looking vision.
That's an interesting analytical challenge. Let's turn to risk disclosures. What's the risk profile telling us?
Risk disclosures were largely unchanged from the prior filing, according to our analysis. However, this is our baseline filing, so we can't make direct comparisons.
So how do we interpret the risk landscape?
The absence of new or escalated risks in the extracted data suggests United views their operating environment as stable. Operationally, This implies they see their current business model and market position as sustainable without major structural changes. For investors, this stability assessment could be either confidence or complacency, and will need future filings to determine which.
Let's examine the balance sheet stress points. How is United's financial structure enabling or constraining their strategy?
United's balance sheet is simultaneously their strength and their constraint. The $5.94 billion cash position provides substantial operational flexibility, but the $11.49 billion debt load creates ongoing financial obligations that constrain strategic options.
Break down that tension for me.
The cash position represents about 30% of annual revenue, which is substantial for airline operations. Operationally, this provides cushion for fuel price spikes, at maintenance events, or economic downturns. For investors, it demonstrates financial discipline and crisis preparedness.
But you mentioned constraints as well.
Exactly. The debt structure, with all $11.49 billion classified as long-term debt, suggests United has managed their maturity profile well, avoiding near-term refinancing pressure. However, operationally, servicing this debt requires consistent cash generation, limiting their ability to pursue aggressive expansion or weather extended losses. For investors, this creates predictable cash flow requirements, but also amplifies the impact of any operational challenges.
Now, let's look at segment performance. Which parts of the business are driving these strong results?
Here, we encounter another analytical limitation. The filing data doesn't include segment-level revenue or margin breakdowns, which is unusual for a comprehensive 10K analysis.
How do we interpret United's business mix without that segmentation?
The absence of detailed segment data in our extraction suggests either United reports primarily as a single segment, or the filing focuses on consolidated performance. Operationally, this could indicate their domestic and international operations are highly integrated, making segment separation less meaningful. For investors, this means evaluating United as a unified airline operation rather than distinct business units, which simplifies analysis but reduces visibility into performance drivers.
Let's wrap up with our monitoring framework. What should we watch in future filings?
I've identified 4 critical items to monitor. First, watch operating margin sustainability, because it will confirm or contradict whether United can maintain these exceptional 24% margins in varying economic conditions.
What's the second item?
Watch debt service coverage ratios, because it will confirm or contradict whether their current debt load remains manageable as interest rates and operational conditions change.
And the third?
Watch cash flow generation consistency, because it will confirm or contradict whether United can maintain their $5.94 billion cash position while servicing debt and funding operations.
What's the fourth monitoring point?
Watch management commentary evolution, because it will confirm or contradict whether the current absence of strategic messaging represents operational focus or communication gaps that could signal strategic uncertainty.
Mike, any final thoughts on United's positioning based on this 10K?
United presents as a financially successful airline operating at peak efficiency levels, but with a capital structure that requires consistent execution. The combination of exceptional margins and significant leverage creates a high-performance, high-stakes operating model.
That wraps our analysis of United Airlines' fiscal 2025 10K filing. Remember, this analysis is based solely on SEC filing data and should not be considered investment advice. I'm Sarah.
And I'm Mike. Thanks for joining Aviation Intelligence Weekly.
We'll be back next week with another deep dive into aviation sector filings. Until then, keep watching the data.